Let's bring in our first guest this hour. Lesley Marks is Chief Investment Officer at Mackenzie Investments. Great to see you.
Good morning.
Lots to think about right now.
Lots to think about.
What are you thinking about? I mean, what out of that sea of stuff, what's first and foremost for you?
Well, I think the thing that we're really focused on right now is watching what's happening with yields. We've seen a big move higher in yields over the last few weeks since August. This almost seemed like there was no ceiling in interest rates, certainly at the longer end of the curve. Now, recently, we have seen some buyers come in, so maybe we have seen a short-term ceiling, but that's really causing us a little bit of concern in the market to say, what's going on the bond market, and seems very detached from the action that we're seeing in stocks.
Is the concern, I get different responses from different guests. Some people are concerned the higher these yields go, the more borrowing costs go up for business. Maybe that squeezes them at a time when we're already concerned about a cool down for the economy. I guess the other dynamic for investors is, if yields are higher, maybe that shifts money away from the equity market, and it could be a pressure point for stocks. But what's the primary concern with higher yields?
I think the concern is really thinking about what is driving higher yields. Is it cost of financing for the economies, for the U.S., for Canada? Is it concern about our own fiscal balance sheet? Or is this about expectations that inflation is going to stay higher for longer? Both of those scenarios are really not very positive for the economic outlook. Generally, higher interest rates are more restrictive for an economy. So no matter what the driver is here, we certainly don't want to see a situation where we have runaway interest rates. In Canada, that would be of particular concern to mortgage holders. I mean, we know that the percentage of mortgage holders rolling over each year from variable rates is about 20%. And we're already seeing anecdotally pretty significant impact for individuals in their rollover rates. So if rates are even higher, every time we roll over, the impact is going to be greater. Well,
and look, the markets are all connected. So even if the Bank of Canada is, closer to the end of its rate hiking cycle, if bond yields in the United States are moving higher, that's still a complicating factor in our own mortgage market. I guess the flip side to all of this, the market in recent days, the stock market, I'm generalizing here, but we are coming off several days of gains. There's been some commentary from Federal Reserve officials who actually point to the bond market and those higher yields as arguably doing part of what the Fed is trying to do and cool the economy. Does it feel to you overall, because you've got to make strategy decisions on where to invest money, does it feel to you at the very least that we're near the end of the rate hiking cycle, or to your earlier comment, do we just not know at this point?
Oh, I'd say absolutely we're near to the end. We think that the Bank of Canada is probably finished from here. I mean, I don't have the crystal ball to say what's going to happen in the long term, but I would certainly have the view today that we are at the end of the hiking cycle, and we could actually be potentially also at the end for the Federal Reserve. To your point, we've seen a little more dovish commentary, but, a week ago, the commentary was hawkish coming out of the Fed, and then we saw this interest rate action, and I'm really glad to see that the Federal Reserve are looking at interest rates across the curve as an indication that financial conditions will be tighter, because there's been a lot of focus on the employment data or the CPI data, but this has to factor into the data set for every central banker.
I alluded to the fact that there's a big IPO on Wall Street today, Birkenstock, 249 years later going public, and then you've got a big energy deal from Exxon, you got a toy company in Spin Master. When you see news like that, does that send a message that businesses are still willing to take some risks, that things haven't really shut down for the economy per se? Is it a bullish sign to you?
Well, I think that in general, deal activity has been slow. That doesn't mean you're going to see no deals across the economy. So yes, on the margin, it's a positive sign. What you end up in an environment with high interest rates is haves and have-nots. Those that have the ability to do deals will do them. They will take advantage of this opportunity, especially where there may be strain on other companies' balance sheets. So the strong will acquire the weak in this environment. And if you're in that position, that's a very favorable position to be in. Now, the oil deal was a stock transaction. So in that case, we're not talking about the strong versus the weak because Exxon's using their own paper to make the acquisition.
Right, and obviously they benefited from what happened to oil prices basically over the last year and change, helped their cash flow picture.
Certainly.
You talked about haves and have-nots. I hear different stock strategies from just about everybody these days. Some people say defense, some people say take your money off the table. Some people say stick with tech stocks. Some people say actually a market like Canada, which has that cyclical exposure, might be a good bet for longer-term investors. How would you think about stock market positioning at this point?
Well, I think you have to look at where we are in the cycle, and it's clear that we're getting towards the end of the economic cycle, and this is really driving what people are thinking about when they're looking at equities. We like to compartmentalize based on sector views, and that's easy in some cases, but it's more nuanced in others where you have diverse sectors within sectors. Industrials would be an example, consumer discretionary, another example. So what you're really looking for here and it comes back to the interest rate picture, which is so important for the economy and for companies, is the most paramount thing to be looking at right now is a healthy balance sheet, because you don't want that funding risk in something that you're investing in at current interest rate levels, because so many companies have enjoyed the luxury of low interest rates. So what I would say is come away from this sector view around, this is a good time to own defense stocks, for example, or this is a good time to own industrials, and look at each company on a company-by-company basis. And that's what each of our portfolio managers do. Every company is based on its own fundamentals and its outlook based on where we are today in the economy, and as I said, very late cycle, as opposed to making a broad brush statement like, I want to be in retail right now.
Yeah.